Good morning, everyone. Welcome to the Market Mindset. We're doing another reaction video, actually two short videos, but they're on the same topic. Two of our favorite people to talk about, but it's JPMorgan's Jamie Dimon and BlackRock CEO Larry Fink, in part because they control a lot of the narrative, and their insight as to what's happening with interest rates is very useful. So let's take a look at the first one. This is Jamie Dimon from JPMorgan.
I just tell people, be prepared for higher rates and slower growth.
7%. Are we really going there? And how does
I don't know. When I said 5%, they said, are we going there? Yeah, it's possible. You know, so when I talk to my board, I say, yeah, can it go to 7%? The answer is yes. Are there factors that would drive it, higher than, where it is today? 4.5, 4.6, or 4.7, I'm talking about the 10-year bond now. Yes. Is supply and demand could push high? Yes.
Okay, let's just stop right there. A 7%. That's hard for people to stomach. I mean, we're at a 5. So if you're walking in doing a refinancing in the US on a 30-year, it's like 7.5%. You were getting 2.5 to 3 years ago. This is a significant change. This could bankrupt your retail, no problem, without a doubt. Now, the issue is that how many people did variable rate mortgages? How many people locked in? If you locked in your 30-year rate, congratulations, you have made an excellent move. But a lot of people didn't. A lot of people just assumed that rates would be pretty flexible and within reason. Right now, in order to buy a home, exceptionally difficult. If you want to get 7% mortgage on $1 million, that's a whole other story. So let's continue.
I'm just saying, be prepared for it.
So
and then the worst case is stagflation. Higher rates because you have a booming economy and there's a lot of competition for capital is not the same thing as stagflation.
what are the ripple effects of the stress of that 7% rates on business, on your growth?
Well, I'm not worried about JPMorgan. JPMorgan, we are prepared. We can handle 7%. We can handle 2% again.
8%?
Yeah, we can handle that too. That risk management is not the same thing as guessing the future.
Okay, let's just stop there. Investment banks have whole risk management departments, and they go over their books and they look at everything. This is an exceptionally important thing that they do. 2008 highlighted that, where they kind of dropped the ball, where the risk management departments, their models were off, or they were misguided with them. But this is a huge factor of when you're looking at an entire portfolio of an investment bank. And a lot of smart minds doing this. The average person, if they're not paying attention, doesn't have those kind of resources or that type of insight as to what everything could look like for their own portfolio, their own assets, their own life insurance plus portfolio plus this and that. It's a very different ball game. So when rates really begin to move, you see it on smaller businesses, medium-sized businesses. The cost of capital to raise money for any of these businesses goes through the roof. So we're seeing a lot less IPOs, a lot less financings, and the financings that are done through more private ways rather than in an investment bank or through brokerage houses. So you can see it causes an entirely structural change. And it comes down to that conversation that first came out, whether this was a structural issue or if it was just inflation for inflation's sake. And once again, different people consider inflation different things. We look at it as money printing, and a lot of people don't. And also, we also rarely don't think that the PPI and CAPI numbers are terribly important. I mean, they're important because some people think they're correct. They're generally revised quite often, and they're generally exceptionally low compared to what the actual running around retail purchase for people. Right now, inflation's through the roof, even though they try to tell us that we've got it somewhat contained. I can easily argue against that. Just walking around trying to buy groceries, the cost of energy, cost of transportation, any of these things. So let's continue.
When risk management, looking at the range of potential outcomes and being able to say to yourself, we can handle this, we can handle this, we don't really expect it, and we can handle the in-between. If you bet your company on one outcome, so I think all companies do that. And every company's got different exposures, input prices, output prices. Some interest rates don't matter, some it's the price of mozzarella. So what's your business? Your business is different. So, but I think we don't know the effect of these things on the economy. So they may we may have a soft landing, we may have a mild recession, we may have a harder recession. Obviously there are potential bad outcomes. The worst one would be economically is stagflation,
right,
where you have low growth, high interest rates, and obviously if that happens, you're going to see a lot of people struggling.
We're going to stop there. So that's the likely outcome. And that's a very pessimistic way of looking at it. I know the news keeps telling us that the market, the economy is strong and resilient and it's more buoyant than ever. But the mainstream news has been wrong almost every time for the past 5 years. So it's not something to laugh about. You're better off to be more concerned and more worried and thinking about what's your plan. Because think of all of the corporations, think of even just the small businesses that took out loans. Think of the people that took out the loans here in Canada from the government, where they're giving $40,000, $60,000, $80,000 out, and they said 1 year you don't have to pay any interest rate. Then we'll apply an interest rate. They're going to apply an interest rate of 8-10%. That's possible. And how are you going to pay that back? And especially you go in and refinance your home as well. So we're about to see things really come to a bit of a halt, and we haven't priced in. I mean, we haven't even priced in any of these ideas of ESG. That they've spent trillions towards a lot of battery plays and whatnot without touching the grid. What's it look like for companies when the cost of just doing business and permitting is also through the roof? So we're definitely in a period of transition. Lots of factors. I don't mean to sound like too much of a wet noodle, but it was important to have that quick conversation and some feedback and some thoughts. Tell me what your thoughts are, what you think of Jamie Dimon, what do you think of his kind of running in between there, and whether you thought his overall message was hopeful, or do you think he's also kind of leaning towards stagflation? Now let's take a look at Larry Fink.
So I think we have to analyze that by each region, because the United States, our home mortgage market is based on a 30-year mortgage. So anybody who has a home mortgage, higher interest rates does not impact them. And so the transmission of high elevated interest rates in the U.S. takes much longer to impact the economy. Whereas in other places where you have more floating rate, or like in the United Kingdom where you have generally a 5-year fixed and then it resets. Okay,
this is an important factor that Larry Fink is making, because according to the Washington Post, by 2021, only 2.2% of mortgage applications were for adjustable rate mortgages, while in 2022, 85% mortgages were fixed 30-year. So all of these new 2022 rates are locked in. So they're locked in for 30 years. So that's a good sign. There are, of course, the people that have refinanced in 2015, 16, 17, 18 with exceptionally low rates. If they had gone variable, they're going to refinance now at exceptionally higher rates. So he makes a good point. Having a 30-year fixed, if you had locked in your rates, this has no effect. This is fine for you. Your cost of living is very manageable. And he's also obviously correct in stating a country like Canada, where you have a 5-year fixed, is much more at risk of the fluctuations in the market, because if this continues, they're going to have to refinance at dramatically higher rates.
And so let's assume 20% of the mortgages have to be, reevaluated at a higher level. That creates more immediacy at higher rates. So I think we're going to see some economies enter recessions early.
Which ones would that be?
Well, I think Europe.
Is anyone's more sensitive to
the ones that are more sensitive to this elevated interest rates, and you're starting to see a real decline in GDP and other. They're basically flat now, but can they go into a more protracted recession? Whatever the recessions we're going to have, they're going to be quite modest. So I'm not even that fearful. But the other issue.
I have a stat for
let me just say one thing,
yes,
Dani.
Yes, then I'll inject the fear.
But I believe if we have labor shortages, if we're getting back to this whole social issue of how are we going to be doing this, in many areas you may need a recession to bring down labor demand. And I think this is one of the things that's going to impact in the United States. You still have a very vibrant economy.
So I got to stop them there. This myth of labor shortages and demand. They like to pretend that we've got a shortage of corporate jobs, a shortage of engineering jobs, a shortage of science, finance. software development. We don't. Those positions are all full. What he's talking about is a demand for Tim Hortons, for restaurants, for very, very low entry level markets. So a lot of times politicians and people like Larry like to pretend that those two things are similar, and they'll say, "Well, we need to drive in immigration because we need to have these jobs filled." But he's not talking about career jobs. That's not the case. And that's a bit of a frustration I have whenever you hear people talking about a need for driving in migration or driving in numbers of people to work jobs, because you're asking them to come in and not live the American dream. You're asking them to be working at a fast food restaurant and plus two other jobs, maybe a ride sharing and Uber delivery in order just to get by. So it's a type of person that presents that argument, and it's very, very frustrating.
The United States and as I said, the J curve of the Infrastructure Act, the CHIPS Act, the IRA, which has huge implications. That's going to be creating jobs, and so it may require a more protracted Federal Reserve, and it may mean by 2025 the United States economy may be entering a recession, but I don't see it any time in the near term.
Now that's even more disturbing, because he's saying that he doesn't think there's any issues right now, which there clearly are. I mean, the U.S. is in big trouble. If you look at any metric and you take the politics out of it, it's not doing well. So if he thinks it's not doing badly right now, but it could do badly in 2025, that's not great. On the good side of things is we can look at the possibilities that AI can bring for efficiency and growth. I mean, that can add a ton of value to a lot of companies very quickly. And we also look, he is true in that the trillions that they're putting out there in an infrastructure bill, that could really ignite the economy. But we're talking some of these battery factories, 2026, 2027, 2028, that's down the road. So for a lot of people just living today, for today, that's pretty far out. It's a lot easier, and you can read the comments, for billionaires to have all the time in the world to make very strategic infrastructure plays and larger macro plays that look promising. And they do. There's a lot of promising things down the road. But what are people doing today to deal with the significant issues that a lot of politicians have caused along the West, let's just say, all of Europe and North America? That's it for now. Larry Fink goes on a little bit more, but it's important to hear both him and Jamie Dimon because, listen, they control exceptional amounts of the market, control of money, and have influence like very few others. Thanks so much for watching, and I look forward to you to sending me some comments, give some feedback, tell me what you think of Larry Fink, and we'll continue that conversation on the channel. Take care, subscribe, find out some more.